all the metrics tell us that everything is going to go up. So things are going to get more expensive. But then on our underwriting, we're saying, no, it's going to actually lose value. And so what that means for our investors is we're going to lose a lot of deals. But the ones we do get, we're probably going to outperform pretty good on those because of that exit cap, right? The exit cap is going to either stay the same or go down, and that's going to make the deal just be a rock star deal.
Lionshare Bookkeeping believes the key to generating wealth is understanding where it comes from and where it needs to go. They provide bookkeeping and financial coaching exclusively to real estate investors, focusing on cash flow, strategy, and action. Go to lionsharebookkeeping.com/apartments to connect with them now. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest and I go through some metrics that he considered the most important to know before moving forward with the project. His name is Ruben Dominguez. And Ruben is a founder and principal of Totem Capital Group. He's a founder of the San Antonio Real Property, LLC, and it's a Texas single-family, multifamily home acquisitions company. He's recently served as an executive for several SaaS companies, and he's grown and exit SaaS companies as well. But on the real estate side, he's grown this business, and you're going to hear about some challenges, his biggest challenge this past year, and how he's overcome that. I'm sure you have experienced some of these same challenges. I know I have. And then also, we're going to get into some of those metrics behind when a deal works for them and when it doesn't. And I think that's going to be very helpful for you as a listener, especially if you are wondering about that for yourself and some things you need to consider, but also some ways around how he has given back in the community and what that's done for his business as well. I know you're going to learn a lot from Ruben today. Ruben, welcome to the show. I can't believe we've not met yet. You were just telling me about somebody else in the industry that's been on the show that a few times that I would consider a friend, and just somebody that's done some big stuff in our business. But you and I have not met before, so just what I know about you, I'm looking forward to this conversation. Give the listeners a little bit about your background, Ruben, in real estate, and I guess give us a little bit about your business model as well, what you all focus on.
Definitely. Yeah. Thanks for having me on, Whitney. I appreciate it. So my name is Ruben Dominguez. I'm a principal and founder of a firm called Totem Capital Group. We are a multifamily acquisition company. And so basically what we do is we help investors invest in multifamily. And so my background really started, I was in the corporate world for a long time in IT. I was a middle management and then executive eventually. And I had a very stressful, very high paying, very demanding job. And I was always I was missing my kids growing up, but I was always looking for a way to get out. And I started with real estate, and we really started trying to acquire single family rentals, and another one and another one, another one. We got to the point where we ran out of money to buy single family rentals, because each one you got to put some money into. And so we started doing flips to fund more rentals. And then we started doing wholesale deals to find more properties and cut out some of the fees that we were paying wholesaling companies, and try to scale that model, the single family model. And I think our biggest year was 2014. We probably did 20 deals that year. And I think we acquired 6 rentals that year. And my whole purpose for trying to get into single family was to have more time. And I actually looked back and said, I missed the entire year. I didn't see my kids hardly at all. There was all weekends, all nights, every free moment I had from my corporate job. I was working on my single family stuff. So I said, there's got to be a better way. I'm not that close to retiring yet with my single family. And so we moved over to multifamily around. I was trying something, and my buddies kept telling me, do multifamily. It's just scalable. But my returns were so good on the single family side, I was really hesitant to move over. But it got to the point where I was I just didn't have time, and I was not spending any time with the family. And I said, there's got to be a better way. And so that's when I reluctantly moved to multifamily. I started to passively invest in people's projects. And then eventually I said, hey, I'm going to come on and co-sponsor, co-GP a project. Actually, it was with our mutual friend that we know. And that's really when the magic clicked in my head. I said, well, that was actually easier than single family, or about the same amount of effort. But instead of doing one single family house, we just did 268 units. It was a 268 unit project. And it was like, okay, my returns are lower, but it's like, it's across a multi-million-dollar building instead of a, a $200,000 single family house. So that's when it really clicked for me. I was like, okay, well, we can do this over and over and over again, just like I did in single family. And so that's when we really started our single family business. And our model, I know to answer that question, is we go out and look for class B and C assets here in South Texas. So Houston, Austin, well, not really Austin because nothing over there. It's really, the numbers aren't working, but Houston, Austin, San Antonio, Corpus Christi down south and the South Texas Valley. And we're looking for some type of value add play. So normally these are older. Some of the units are dated. We like to go in there and upgrade them, make them nice, make it a nice place for tenants. And we hold those for, 3 to 5 years normally. And then we sell them, and it's a win for our investors. It's a win for our tenants, and it's a win for us. So that's been our business model for the last few years. And we got some pretty lofty goals this year as well.
That's awesome. I appreciate you elaborating just on the business model a little bit. And, the bio that I had for you said, a Texas single family home acquisition company. Maybe you were a single family acquisitions company, but now you're a multifamily acquisitions company. So, but I want to get into that some more, but I also said something about being executive in some SaaS companies as well. How is that connected to the real estate industry at all? Or what does that look like?
I wouldn't say the software piece is. So SaaS is basically software as a service company for people that don't know. And so those are like your online subscription-based models of software. And so not really directly correlated to that, but I think I was in operations. And so the operational stuff and the metrics we looked at and, how to run a team, that stuff is really directly translates to multifamily, because I can look at a financial statement, which I did, and I can look at an apartment financial statements. It's kind of the same stuff, right? You got income, expenses. You're always trying to reduce expenses and increase the income on property, just like we were in SaaS model. So now and it's kind of like a subscription, right? Your tenants are paying you every single month. And the same with the SaaS model, your customers are paying you every single month. And you got to make sure you're providing a great value to them so they continue to want to do that. And they continue to want to, and with tenants, it's like, hey, we're going to give you a little bit of a rent bump every year to keep up with inflation. And we want to make sure that they're happy to pay that and not go look for somewhere else. Because, if you're going to raise the rent $20 to $50 a year, it's like, do they want to go look somewhere else? You want them to not have to question that. And that was the same thing in a SaaS company. Like, you don't want your customers they can cancel on you at any minute, and you don't want them to do that. You want to provide a great value for them. So they're happy to pay that every single month.
Yeah, no, that's awesome. I just wondered if there was any connection there. But obviously on the multifamily acquisitions piece, I wondered, what's your biggest challenge this past year, in multifamily acquisitions? And let's talk about that a little bit.
It's finding a project that works for us, where we're pretty conservative on how we analyze a property, and because we're raising capital from investors. And, we got to be good stewards of their capital, right? It's more important to me than if it was my own capital. So we're real careful. And because of that, it means we lose a lot of deals that we probably could have bought. We probably would have made a lot of money on, but we don't want to buy it because if something happens with the economy or the market and it's so tight that we're like, I don't feel good about that. So it means that we have to analyze a lot of stuff. We analyze, probably 50 deals a month, and we have to form a lot of relationships, do a lot of networking. But that's probably been the biggest challenge, to find something that works, especially here. It's a really hot market in Texas. And so we got a lot of competition, a lot of people that are coming in with money that sometimes I lose deals. And I'm like, how did they pay what they paid for that? I have no idea, but I guess it might be institutional money, 1031 exchange money. I don't know, but that's been the biggest challenge for us. Definitely.
I would agree completely. There's a project we were looking at, and it sold maybe 3 years ago for 200 a door, and they're looking at 400 a door.
Oh my gosh.
And it's like 80s vintage,
wow.
It's hard to believe. But anyway, so let's talk about that a little bit. What's been, a successful way that you all found a project to buy?
All relationship. The last 2 projects that we bought were based off our relationships with brokers. And they know we have so one of our big key pillars is when we submit a letter of intent, that price is, we close at that price unless something major happens or we find something major. And it's got to be pretty big, right? It's got to be probably $100K for us to go back to that seller and say, hey, we found this and we didn't know about this before we bought. So, and we got some things that we do to make sure we don't find those big surprises. Like sometimes we'll ask for an early access agreement. So before we sign a contract, we'll get in there and we'll look at the property pretty closely, get some contractors in there, just make sure we're not missing anything. But that's been the biggest key is, you want brokers confident that you're a closer and you're going to close at the price that you agreed upon. And then you want the sellers confident that you're going to do that, because it's a pretty small world. There's a lot of multifamily, but there's in every market, a handful of buyers, handful of brokers. So
that's right.
If you ruin that relationship, they're not going to bring you deals, right? Yeah. And we want the ones that, so last two were, hey, we really need to sell this pretty quickly. One was because they had a loan coming due, so they had to pay the bank back within a few months. Not a great position to be in. So if you have somebody come back and say, I can't close, they can't execute, that might put them in a bad position. And the other one was they needed to get that equity quick because they were buying a big portfolio, like a $700 million portfolio. And so they needed to unlock that capital and that deal to put in the other one. So they only brought it to 2 or 3 buyers that they knew could close. And so that's how we got those last 2 deals.
So outside of just track record, right? Time. I mean, we're experiencing that as well. I mean, we get deals from brokers that obviously we've sold and bought projects with, they know we can close all those things, but somebody that's getting started, man, that's frustrating, right? You got to start somewhere. But any tips outside of that for building that kind of relationship with a broker, outside of just the time and track record, that would be helpful.
Definitely. I think the easiest way to get in is, and I tell this to people all the time, it's don't go out there. If you've not ever done a multifamily deal, like don't go out there and try to contact brokers, because they're not going to know you. They'll probably send you stuff, but it's going to be the stuff that they're sending everyone. It's probably overpriced a little bit. It's not going to work. And everyone else is like, I'm not quite there. And they're going to hope you're going to buy it at a higher price. What you really want to do to get a good track record is you want to partner with someone that has a track record in whatever market you're looking at. So go find a Whitney, right? That's you got a track record and you got to bring some value to that person, right? They're not going to just partner with someone like just because you want to be in multifamily. You got to bring some value, but that's the best way. And then you do a few deals as a partner. You do some work, right? You're going to have to do some work hard to provide value for that partner. But after you do 2 or 3 of those, then you can confidently go to a broker. And the first question they ask is like, hey, what's your experience? What are you looking for? And you can confidently say, I've done 3 deals and here they are. They're in the market. Yes, you're a partner, but that still gives you some credibility because you know what you're doing. And then also you can confidently, when they ask you that question, you can say that. And you also, now you kind of know what you're doing because you've been on the lender calls, you've been on the asset management calls. And so you're not the newbie out there trying to buy a deal. I think that's a huge mistake. If you're a newbie out there talking to brokers and you don't know your buying criteria and you don't have a track record, they're not going to be too confident about your ability to close, which is the number one in multifamily. It's like, do you have the ability to close this deal? That's right.
No doubt about it. You mentioned too, you said like that challenge is finding a deal that works. Could you give us a couple of those metrics around, what makes that deal work, for you? What are you looking at there? Maybe that could be a passive investor that's asking you that. Let's make that scenario. Passive investors asking you, okay, Ruben, what makes a deal work for you, especially in this environment?
Sure. Yeah. So our number one metric we look for is the return that we can provide to our investors, our passive investors. That's the biggest key. If we can't make that work, we won't buy the deal. Now, the trick to that is we have a couple metrics. We want to be conservative on our rent growth. Like what can we actually get in the market? If we do, let's say we do a remodel and we're going to spend $5,000 on the remodel and the interior, can we get X amount of rent bump for that conservatively, right? Not because I know I've seen some projects out there from some other operators where they're projecting rents that are really pushing the market. We don't like that. We like to do a rehab and then get market rents, right? We don't want to be the most expensive place out there. We want to be about where everyone else is. So That's one of the metrics. We don't want to overproject on rent. Second one is we don't want to be too crazy on expenses. Like, it's expensive to operate these properties. We don't want to say we can save so much money on expenses and run a really tight numbers. And then you get into trouble later on with operationally, you can't really operate correctly because your expenses are higher than you projected. And then I think the biggest one for us is, and this is where we lose most of our deals, is cap rate, right? Our exit cap rate. And for those that don't know that may be listening, cap rate is basically like, I have to think of it as what the market would pay for an asset. And so the lower the cap rate, the more expensive the property is, the higher the cap rate, the less value the property has. And so right now, what we're seeing, especially in Texas, is cap rates declining, which means things are getting more expensive. But in our underwriting, when we project out 5 years and an exit, we're actually increasing the cap rate, meaning that the property is actually going to be less valuable for the market when we sell it. Now that makes us lose a lot of deal because just a few basis points on a cap rate can make or break your deal. And we're writing in, half a point on an exit cap from where we go in normally. And what's probably going to happen though in Texas, if anyone knows Texas right now, is that cap rates are going to continue to go down, which we've seen over the last couple of years. And, all the people moving here, all the jobs coming here, we're right down the road from Austin, it's about a 45-minute drive. And so it's all the metrics tell us that everything is going to go up. So things are going to get more expensive. But then on our underwriting, we're saying, no, it's going to actually lose value. And so what that means for our investors is we're going to lose a lot of deals. But the ones we do get, we're probably going to outperform pretty good on those because of that exit cap, right? The exit cap is going to either stay the same or go down, and that's going to make the deal just be a rock star deal, but it might not, right? We're predicting the future. It might not. So if values don't go up and we projected that they're going to go up, right? We may potentially lose money for investors, and we never want to be in that position. So
of course. No, that is great. And also on the return metric, we're very similar in what you just said. It's like, if we can't hit a certain return metric, then we're going to probably move on to the next project. And I love what you highlighted there. Obviously, conservative rent growth and our expectation of expenses, right, and that exit cap rate, so important. Is there a specific, say, return metric or a couple that you're going to focus on when saying, well, let's say, we've got the rent growth and the expenses and the cap rate where you want it, but what does that return metric need to be, or before you're going to say, we're passing this deal, or we are going to move forward?
We like to look for, so I like to talk in terms of average annualized return because it's simple for investors. IRR is a better metric because it gives you your time value base, your time value of money, right? It's not just because as time goes on, the longer in the deal, the less value that deal is. But it's really hard to figure out in your head. You got to get a spreadsheet out to figure that out. So we like to talk in terms of average annualized return. Because if I tell you, hey, Whitney, if you invest $100K in my deal and I give you $100K on that in 5 years, in your head, you can be like, that's a 20% return. Because if you give me $100K on my 100 in 5 years, it's 20% annualized return. Super quick, super easy. Your IRR on that's probably going to be around 16, 17, somewhere in there. But it's so hard to figure out. You got to get a spreadsheet out. So what we're looking for on our deals is 17 or better average annualized return right now. Now, obviously, as the market changes, things get more expensive. Maybe that comes down a little bit. And obviously, that's a fluid metric because, if it's more expensive, maybe you can't hit that return. And we still got a 15 is still pretty good, right? When you compare it to some of the other assets out there, some of the other investments out there. But right now, that's kind of what we're looking for right now, at least a 17. And we want to be able to beat that, but we want to at least be able to confidently say, I can hit that for sure. And then if we outperform, even better.
Yeah, no, that's great. We've also started using average annualized return for that exact reason too. IRR is hard to calculate, hard to explain. However, oftentimes I'll say, if you gave me $100, I said I could turn it into $1 million. You'd say, hey, could I give you a lot more than 100, right? But if I said it's going to take 300 years to do it, right, you're going to say that's not okay. That's not such a great deal now, right?
Exactly.
It calculates time, right? Brings time into the equation. So conservative rent growth, expenses, cap rate. One note on exit cap rate. Is that, how are you all thinking about exit cap rate? Is that something that's going to fluctuate much? How are you say, okay, half a basis point, is that going to be a basis point another time or per project? Or I guess walk the listener through that a little bit.
So on our underwriting, just to be conservative, we're writing in about 10 basis points a year in the cap rate going up. So, because what we're actually seeing right now is about 10 basis points a year in the cap rate compressing. So it's going down, but that's just to keep us conservative. Because when we look at, over the last 60 years in multifamily, you normally don't see cap rates going up more than about 10 basis points a year, unless you're in a crazy market like Las Vegas in 2008. Your cap rate's going way up over there, more than 10 basis points a year. But if you look overall average in the United States over the last 60 years, you'll see about a 10 basis points a year in cap rate going up when there's some type of economic thing happening. So we feel that's pretty safe. I don't see a scenario where it goes up higher than that, especially here in tech. We got job diversity, we've got industry diversity, we've got a lot of people. So we're not if I was in a market where maybe it's oil market, like in East and West Texas, I might write in a much higher cap rate, like accelerating cap rate. But I think we're pretty safe with 10 basis points a year.
Yeah, no, I appreciate some detail there. That can be a complicated kind of subject for a lot of listeners as well, as we think about exit cap rates and what that means. But what about, just being an operator and your level of experience? Do you have any predictions for the real estate market over the next, say, 6 to 12 months?
I think, everyone's talking about inflation right now, right? And so I feel that multifamily still has a lot of room because of inflation. Because when you have inflation, you want to be in an asset that is you don't want cash, and you potentially don't want to be in the stock market, because if rates are raised by the feds to kind of cool off the economy, right? That's why you raise rates, so people stop buying, kind of cool the economy off. A good place to be is multifamily, because we just got a loan at 3.5%. And so the bank stuck with that for 5 years. As long as you buy a rate cap and you're not, you're conservative with your debt that you're getting on a property, you're in a good spot, because the bank's taking the inflation. We're not really taking the inflation. We're winning because our rents keep going up and up and up and up, but our debt's staying the same. So what does that do? It makes our deal look great. I think we can ride out any kind of like inflationary stuff that happens in the economy. So I feel like multifamily's got a lot of room because of that. And people are flocking to multifamily right now because that's where they want to put their money. They don't want it in stocks, and they definitely don't want it in a bank account where it's just going to be eaten away. So
that's for sure. Tell us a little bit of advice around, say, preparing for a downturn. A lot of people say, is there going to be a crash? Is there something coming? Or, obviously there's cycles in real estate. We all know that. Nobody has a crystal ball of what's going to happen tomorrow, next month, the next year. However, we still want to be prepared, right? For when that happens. What are some things you're looking at, when you are looking at that project moving forward, that we want to make sure we have in place, that we are prepared?
I always like to say 2 big things on your projects is your debt. You got to be careful, right? If you're going to get a floating rate and rates go up, you want to make sure you buy a conservative cap rate on that, because you don't want your rates to go up. So you got to have a cap on that. It's going to cost you some money up front, but it's going to keep you safe in case something happens. And the big one is make sure that you are well capitalized on your deals, right? So you can float it for a few months if you have to. If something crazy happens, you want to be well capitalized, because you don't want to run the deal so tight where something crazy happens and you can't afford to pay your debt, or you can't afford to pay your bills. Like, you got to be well capitalized. So if you're looking to get into this business, like, that's super important. You either need to be well capitalized, or the deal does, or you bring a partner on that is well capitalized that can help that project along if something happens.
Yeah, no doubt about it. Such great advice. Do you have a way of measuring that? Do you all measure like so many months of expenses, or a percentage of something, or anything like that, to say, this is our emergency budget, or this is, how we're capitalized to handle some kind of downturn? Oftentimes, you talked about something happens and you can weather it for a while, but sometimes not just one thing happens, but 2 or 3 things happen, right? And then you're in trouble if you're not well capitalized. Do you have a way to calculate, or anything metric that you all use for that?
Yeah, so we have a percentage of just operating capital. Depends on the project, but there's a percentage we put in there. And then also we stress test the deal to say, hey, what if we went to 60% occupancy? Like, what does that look like? And how much money do we need to keep ourselves alive for 6 months? That way we can weather a storm. And, if we're in an environment, we can't keep occupancy at least 60% for 6 months, then we got bigger problems usually. So that's kind of the stress test. And it means also that metric also, because we're going to probably raise some of that money from investors. But obviously every dollar we raise from investors and we're telling them we're going to give you 17% back on that means that it's going to make the deal less attractive, which means we lose more deals, but it keeps us safe. And it's all about keeping our investors' money safe. Like that's the number one. We got to keep it safe. We got to be conservative because we never want to lose or even not under deliver. Because if I tell someone 17% and I deliver 16.9, we didn't deliver on our promise, and we never want to do that. So we have a lot of those metrics to make sure that we keep our investments safe.
For sure. Speaking of investors, what's your best source for meeting new investors right now?
Those are going to be local meetups. So we have one in San Antonio every month. That is where we meet the majority of our investors. And then we go and we try to get speaking engagements in other cities. And that seems to be, people want to meet you, talk to you, be in person with you, shake your hand, kind of get to know you. That's where the best source, obviously there's other ways to meet investors, but that's been our best place to meet new investors is in person, face-to-face, local meetups. And there's probably some in almost every city in the US. You just got to find it and then start showing up to those because they want to meet you too, right? Investors want to meet good sponsors that are doing good deals out there.
What are some daily habits that you have that you're disciplined about that have helped you achieve success? I
always try to do some type of workout or physical activity every single day. And then I try to spend at least a couple hours without any electronics, just with my family, right? Just say, hey, let's sit down and have dinner. And then lately it's been homework time. My kids are at the age where they're bringing home a ton of homework. So it's like, okay, let's get rid of that. And they help you with that homework. And we kind of bond during that time too. So those are really the two things, some type of physical activity in the morning and then some family time at night without any distractions. Cause I'm sure this too. People call you all day, they text you, there's Slack, there's email, all kinds of distractions, but just try to put that away. And I'm trying to enjoy it too, cause my kids will be out of the house before I even know it. And I'm trying to enjoy as much time with them as I can while I still got them. Right. So
it doesn't matter what age they are. Before you know it, they're going to be gone. Right.
Exactly.
I appreciate you highlighting, like even putting the electronics away. It's difficult for me. I mean, we've worked on that, right? My wife and I too. We're like, even in the morning, it's like leave it on airplane mode till 8 a.m. Right? Just so you can conserve that mental time, right? Even the time, with my wife and I in the mornings before kids get up, right? Just so that you're not distracted in every way by that email that came in or, that text or Slack, like you mentioned. So great advice. Ruben, how do you like to give back?
I think we talked about this a little bit before the show, but there's a lot we do to give back, obviously financially. Every project we do, we give a portion of that project from our own, not from our investors, but from our own profits. We give that back. We pick a nonprofit organization in our city. We like to give back to our city, right? Because they've done so much for us by providing opportunities for us to go out and do real estate transactions. So we like to give back. We pick one, we give a percentage back to every single one of those organizations, every single project. And then also not just financially, right? That's a financial give back, but we also, we like to give our time, which is more valuable. And so one of the ways we volunteer in an organization called CASA, and basically that's a court appointed child advocate. So we are the judge's eyes and ears for whatever child protective service case. So basically it's not a custody case, but the state is trying to remove the child from the parents for whatever reason, lots of reasons, lots of bad stuff. But these cases go for 1 to 2 years. And so a lot of times when a child's put in the system, the attorneys, the CPS caseworker, sometimes the judge, like people change on the case. And so really the CASA is the constant person in that child's life. Could be for 2 years. Sometimes like they're put in shelters or homes and they're moved at the drop of a hat, and it's real disruptive for that child. And it's really good to be that child's person. Like, oh, this guy's been around for 2 years, and 2 years in a young child's life is a lot of time. So that you really form a bond with them, and you kind of help them. You watch them. You can kind of check up on their grades at school, see how they're doing. Sometimes they need simple things like glasses, right? And maybe the teacher and their foster parent didn't realize that because they've only been with them for a couple months, and then they change schools. And so it's a real good way to give back your time. It's a lot of work. If anyone's looking to do that, you're going to spend a lot of time, but man, it is so rewarding and it's so needed. There's probably, I think in the county we're in, there's about 6,000 child protective service cases every year. Now, a case could be multiple children, not just one. And right now, I think about 3,500 of those have a CASA. The rest don't. So I feel real concerned for those cases that don't have one, right? And so, because I don't know what that child's going through, but that's a super valuable way to give back. And we love to do that. And it's totally worth the time if anyone's interested in doing it.
I appreciate you sharing that. And the listeners know I've talked about how we love to give back and how that's changed our lives and businesses. And now, even changing, it's changing many people's lives and families now, because of that desire the Lord's given us. But tell us, how has that changed your business? This desire to give back in this way. And also I wanted to highlight, you mentioned not just financial give back, right? But your time, right? You mentioned that takes a lot of time. But man, that is oftentimes much more valuable than any amount of money at that moment or in that situation. So how has this changed your business?
And it's been everything really for the business. One of the pillars of our business is how do we give back to everyone that we come in contact with? Tenants, our property management partners, our partners on our projects, our investors, the neighborhoods that we come into contact with where we're buying these properties. And so we kind of try to focus on that. And that's been a really key to our success, right? We want to give back. We bought a property in September. It was in really bad condition, disarray. I mean, we walked into some of these and the tenants were like, I haven't had electricity in 6 months on that side of my apartment. It's like, what? That's not cool. Like, you're paying good money to be here. And, so it feels real good to go in there and fix that kind of stuff and then make it a nice place for the people to live, and little things like you talk about giving back your time, little things where it makes a big difference. Instead of like this Christmas, we went and we bought gifts for all of our property management teams that are on site. Those guys are working hard, right? Those guys and girls work real hard every single day. And we went and personally delivered gifts to them, right? I could have sent it in the mail. It wasn't anything huge, but a little gift. And I think it meant a whole lot for us to walk in there and say, hey, thank you for everything you've done for us this year. Here's a little small token of our appreciation. I think more was us being there with them on the property. And so that kind of stuff's important, I think, in giving back.
Yeah, no, that's incredible. I appreciate you encouraging us in that way and the listeners as well. And even talking about how that's changed everything for your business, right? Oftentimes it's, we don't think about that side of it, right? Giving back. It's, yeah. So I appreciate you bringing that up, but grateful just to meet you, have you on the show, talking about your biggest challenge through, finding deals, those relationships with brokers, but even some of the return metrics around what makes that deal work for you all, and some of the things that you better be focused on, right, when you're moving forward with the project. And so I appreciate that and just your transparency in that. But then obviously going through how you all give back and encouraging us to do the same. Tell the listeners how they can get in touch with you and learn more about you. And I want to give a shout out to Devin Elder as well as our mutual friend. And I know you all also have a multifamily course, that you all help people with or to learn this industry. So you're welcome to shout that out as well, as many of the listeners are always looking for more educational tools, right, to get into this business and to do it well.
Yeah, definitely. So I guess the easiest way to get in touch with me is you can email me. It's Ruben, RUBEN, and that's at Totem, like a totem pole, totemcapitalgroup.com. Also, our website is www.totemcapitalgroup.com. Our education is called Apartment Educators. You can go to apartmenteducators.com. That's basically, we teach people to do this business. And that was really I think we talked about this, not really a tool for us to go out and make a bunch of money. Like, our main business is buying apartments. That was really a way with us to work with people that are serious and committed And because this business is all about partners, right? We use partners for everything. And that's another way we kind of give back. It's a win-win, right? When I help somebody, I might be a key principal for them, sign on the loan for them because they can't, because they're building up their net worth still, right? And their liquidity. And so if I can help them sign on the loan, I get a little piece of the deal and they get to go out and do a few deals because of that. Like that's a win-win. I love to do that. And so that's really why we started that coaching group, is to help those people. And really, and you know this, in this business, you get a lot of people asking you, teach me. And you can't really give that time. And most people aren't serious about actually learning, especially when they find out how much work's involved. And so that was an easy way for us to point them in that direction and only work with serious people. So it's definitely been great. We've helped a lot of people get into the business.
That's awesome. That's awesome, Ruben. Thank you again. And for sharing that. I hope the listeners will check that out. And I look forward to staying in touch with you, Ruben. I hope you and the listeners have a blessed day.
Yeah, you too. Thank you, Whitney. I appreciate you having me on.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the #1 resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.